Good morning, everyone. It feels a little bit incongruous on this beautiful day in this beautiful venue to be talking about all the world's problems, so I'm glad Sandile ended on a positive note. Unfortunately, I'm going to take us back a step and reiterate some of the challenges that we all face. But I do promise that certainly towards the end, I am the eternal optimist. I genuinely am. We will start to talk about solutions and addressing many of these problems. But let's underscore that critical situation in quite stark terms. We came across a study some years ago that had tracked the average temperature and the average precipitation in summer in the state of California over a period of hundreds of years, okay? And what we found quite fascinating, thinking about the cause and effect, and here, of course, we are talking about climate change, was that there was a clear correlation, a clear trend driving negative outcomes related to climate change-related events. And I propose to you that following all of this analysis, we successfully identified the first corporate climate victim of large-scale corporate victim of climate change. So how did we look at it? Well, we looked at observations of temperature and precipitation in the state of California up until the First World War, so the turn of 2 centuries ago. And along the lower axis, you can see the precipitation, and along the vertical axis, you can see the temperatures in summer. So this was the cluster of observation over a couple of decades. And in the post-war period, what we were able to observe was that the summers were starting to become drier and hotter consistently over time as significant industrial activity was undertaken post the 2 world wars of the 20th century. More recently, that became quite an acute trend of even drier and even hotter summers. Can anybody tell me what tends to happen when you have hot, dry summers to an extreme in a place like California? Fires. Exactly right. Causing the loss of human life, quite tragically. And in 2017, we had some extreme forest fires. You probably saw that in the news. You've had your own forest fires here in South Africa. And in 2017, there was quite an extreme set of forest fires. Now, who here has seen the film, I'm probably showing my age, featuring a young Julia Roberts called Erin Brockovich? 1980s movie. Does anyone remember that one? I think she was at her finest back then. And so, you know, from an acting point of view, gentlemen. She, of course, exposed a company called PG&E, Pacific Gas and Electric, and toxic drinking water related to poorly operated assets in their portfolio. Now, a colleague of mine and myself went to California some years ago. This is an exciting road trip, I must tell you. Didn't spend any time in the beaches or in Beverly Hills or on the Walk of Fame or any of that. We drove around the state meeting every single investor-owned utility. Pretty exciting, right? Not really. And there was one company that we really struggled with, and it was PG&E. Didn't really want to see us. You know, we're pretty hard-hitting in our questions, the way you operate your assets, your history. They've had other issues around a gas pipeline called San Bruno, which exploded, having been mismanaged, also costing human life. And they wouldn't see us. We couldn't really engage. We had a look at their operating practices, and we said, we're not seeing this company as investable. As it happens, by the way, an ESG ratings agency that will not be named ranked this company very highly, funnily enough. So illustrating the importance of actively scrutinizing sustainability practices. In any case, in 2017, we had these significant California wildfires, and PG&E was implicated in having sparked one of those major fires, okay? Because of course the company has these electricity transmission assets in very forested areas. They need to maintain the vegetation. They need to make sure their substations and their power lines are properly managed, they're properly insulated, and so on. And they were implicated, and there was a potential liability associated with them having sparked the forest fire. And as all of you know, in the United States of America, if you get sued, it can get very expensive. So subsequently, they had to eliminate their dividend for obvious reasons. And they managed to bump along for a little while until the next set of California wildfires in 2018. Because remember, those summers just keep getting hotter and drier and hotter and drier and hotter and drier. So that's the share price of PG&E. And very shortly afterwards, after having been proven to have been liable for starting these forest fires, PG&E declared bankruptcy. So had you been invested in this company, and I don't want to play down in any way the loss of human life, because here we're talking about investors losing all their money, but you are all investors, so we're going to make the point. The equity investor ended up with nothing, absolutely nothing. So that's a real example of how climate change can not only affect human outcomes, but investor outcomes as well. So scrutinizing these types of risks is critical, but more importantly, solving the climate change issue is becoming increasingly important. So the United States is not having a good go of things. The red line on this chart is the number of weather disasters classified as severe, costing more than $1 billion. And the red line is 2023. The other lines are prior years. So it is getting worse. It's happened in California, it's happened in Texas, it's happened on the East Coast, of course. And so the solution here that I obviously want to come to is the essential nature of infrastructure in solving the issue, whether it's drought, whether it's forest fires, as we've discussed, or landslides, or flooding, or hurricanes. You're all very familiar with this. And there's a wonderful quote by the executive director of the UN Economic Plan suggesting that infrastructure is a key to addressing the triple planetary crisis of climate, biodiversity loss, and pollution. And here in South Africa, it's pretty dire as well. This headline jumped out at us, where the country recorded more natural disasters in the last 12 years than any other African country. And that's the climate change-related outcomes that we face. And this, we're not going to pick on Eskom. I think that's been done enough. Maybe I will a little bit. This is not okay. We came across this chart of cumulative load shedding last year up until the date that Sandila mentioned. We couldn't get any more data from Eskom for some reason. It may be because they're embarrassed about where it's gone, or maybe they're just working very hard to fix the problem and don't have time to collect data. I'm not sure. But it's not okay, and I've spent more than 3 weeks in the country, and I've got to know this issue firsthand. I rented a little Airbnb for a few days, and I woke up one morning and there was no power. I forgot to check the load shedding schedule, and I wanted to make myself a coffee. And I thought, what am I going to do? There's no power. What do I do? What do I do? What do I do? So I thought, I know. I'll plug the kettle into the inverter. I have a feeling I'm going to get a big bill from the Airbnb host at some point for that, that misstep. But infrastructure, as we've highlighted, is the solution to the problem, particularly when it comes to the energy transition and addressing climate change through more sustainable forms of electricity generation. It might surprise you that roughly half of the investment in renewable energy outcomes is undertaken by the utility sector, mainly investor-owned utilities. So it's not governments coming to our rescue. And outside of that, you can see governments are typically only 3% of the solution around renewable energy. The rest is, as I say, utilities, financial players, households doing their part. Imagine, households are doing more than governments, twice as much in solving the issue by installing their own solar panels and other sustainable forms of generation. So it is the solution, and it is an important contributor to achieving the Sustainable Development Goals. Now, in the fund that I manage, and we'll talk about it shortly, and we are unique in this way, we actually undertake an effort to measure the contribution to the UN Sustainable Development Goals and their associated targets. Okay, and this is really important because we have the overarching goals. Of course, we have the specific targets, which are classified by the numbers around the middle, and we measure how much of the Sustainable Development Goal contribution is made by each of our companies, revenue line by revenue line by revenue line, and then we disclose that. And we've done this in keeping with the framework that was published by the UN, and this revolves around not just renewable energy, but social infrastructure, drinking water, health, and even digital connectivity. You may have seen on the chart that Sandila put up that digital inequality is a major concern as well. And we address that, including here in this country, as you'll see in a moment. So today, we're very proud that the fund contributes, by way of its activities and the underlying assets, more than 80% to the UN Sustainable Development Goals and targets. And that, again, is something that we measure. So let's talk about how we invest, what we actually do. So we have a unique strategy in listed infrastructure. Some years ago, working at M&G, which has a private infrastructure group, we saw the opportunity to complement a private infrastructure, equity infrastructure offering with a listed offering that is global. Most private infrastructure strategies tend to be regional. Our strategy is global. Our strategy is listed, so we have the flexibility by sector, by subsector, by infrastructure category, and of course by region, to invest where we see the biggest opportunities. So it's very flexible, and the liquidity that it offers, particularly for institutional clients, allows for exposure to the asset class without having to lock up capital for long periods of time. And I would argue, and we have lots of evidence around this, that you're also accessing the asset class at much more advantaged valuations than in the private sector. And the reason for that is in private infrastructure, we have huge amounts of capital chasing very few assets. And so prices have been pushed up, cost of capital in that framework is very low, and so the opportunity set is very limited, and we know this from the conversations that we have with our own internal group and others. So the likes of BlackRock, the likes of Macquarie, the likes of Brookfield have been raising billions and billions and billions of dollars to invest in the infrastructure opportunity. And so the valuations as a result in the private realm have been pushed up. And part of why we know this is because private investors have been coming to the listed market and taking companies away from us. So they see the valuations being highly attractive, and they say, right, we'll make a takeover bid for that. One example that we have is a company that we invested in a couple of years ago called Vantage Towers. Vantage Towers had mobile towers throughout Europe and was spun off by Vodafone. So many of the telcos have been spinning off their fixed infrastructure assets to focus on subsidizing your handset and trying to take you on as a 2-year subscriber. And we were a cornerstone investor in Vantage Towers when it was listed. We've been following it for many years. We had a good, solid position. We did very well through that holding. And then one day, KKR, the private equity house, their infrastructure function came along and said, we'd like to buy that, and we'll pay a 40% premium for it. So, okay, and off it went. And that's just one example of what we've been seeing in listed infrastructure. So what do we actually invest in? Critical infrastructure assets, long life concessions, where the concession holder takes the ownership of the asset and operates it over a long period of time before giving it back to government, sometimes as long as 100 years. We have one asset in our portfolio, a toll road in my home country, which, by the way, is Canada. I am not American. I just need to highlight that. Canadians go to great length to make sure people are aware of that. So that was a 100-year concession. And finally, perpetual royalties. This is unique to our strategy, where the underlying infrastructure asset is actually land holdings, and the royalty holder takes a perpetual cash flow stream from anything that's produced by third parties on those land holdings, whether it's mineral or energy or what have you. So very long life cash flows is the important common denominator for these assets, and physical fixed assets. Okay, I often get asked about construction companies, steel companies, cement, all these things. We don't invest in those kinds of businesses, even though they tend to benefit from an upswing in infrastructure spending, but they don't have those physical assets that give us the opportunity to harness very long-term cash flow streams. So we're talking 20, 30 type year cash flow streams, and that's why private investors are investing in this area. Sovereign wealth funds, pension funds, endowments, insurance companies have long-dated liabilities because people are living longer. They don't know what those liabilities are going to be, especially if they have inflation obligations. And so being able to capture reliable long-term cash flow streams, particularly ones that grow, is the way to offset those future liabilities. And the way I think about listed infrastructure for everyday investors is exactly the same. One day I'd like to retire, maybe here in South Africa. And in 20 years, I want to know that I have that cash flow stream coming from this asset class. So what do we invest in? We have three components to the strategy. Most infrastructure strategies only have one, the first one, which is often called core. We call it economic infrastructure. What would be very familiar to all of you if I talked about infrastructure: utility businesses, energy infrastructure, and transportation infrastructure. We sometimes think of this as old economy infrastructure, but of course it's extremely important, particularly in the utilities realm, to ushering in the energy transition and, importantly, as you all know, energy security. So we get a very healthy dividend yield from this component of the strategy. We only invest in listed securities globally, and we get a GDP rate of growth type increase in the dividend stream over time. We only focus on businesses that are growing their income over time. We're not just chasing yield, okay? Because again, when I retire, I want that higher cash flow in the future, not a fixed cash flow. And so we get dividend growth in and around GDP type rate of growth. And this, of course, importantly, also provides inflation protection. Growing income, the only way to properly insulate yourself against a higher cost of living. So that's all fine and well. This is important. This is critical to the functioning of economies. And for us, it's between 2/3 and 3/4 of the overall exposure of the strategy at any given time. But to this, we add an important, critical component of infrastructure that is key to the functioning of society, which we refer to as social infrastructure. You don't tend to find this in listed infrastructure strategies, but you do find a lot of it in private infrastructure strategies. Private equity infrastructure investors in things like hospitals, state care facilities, universities, schools, federal and municipal buildings, and so on. And we're able to access this component of the asset class through listed securities. What we get here is a real defensiveness in terms of the characteristics of the component, where we get a generous dividend yield that tends to grow with inflation protection. And this is an area that, for example, will do very well in a difficult market environment, such as the global health pandemic. That was the best performing component of the strategy in early 2020, when the world was spinning backwards and we didn't know how things were going to go. And these, in many cases, are referred to as availability-based infrastructure assets rather than demand-based assets. And what I mean by that is, for example, toll roads. You tend to get paid well if people are traveling on the roads, cars are traveling, cargo is traveling, so demand-based. Whereas social infrastructure businesses, typically, if the facility is available, you are getting paid, typically by a government. So during the global health pandemic, schools were closed, hospitals were obviously open, but schools were closed, municipal buildings were closed, libraries were closed. Not that anyone goes to libraries anymore, apparently, but we were getting paid for the availability of that infrastructure regardless. And then we get on to the really exciting stuff, the high growth structural opportunities in what we call evolving infrastructure, which mainly revolve around digital infrastructure assets. So without towers, without data centers, optical networks, and so on, we haven't got any internet, we haven't got any Zoom calls, we haven't got any dating apps for those of you that are single. We haven't got mobile connectivity. No, you laugh, but you know, my kids would give up running water before they'd give up Wi-Fi. We were talking earlier about how none of them shower anyway. So transactional infrastructure also key, and Africa is a great example of how digital payments have facilitated access to banking services. So this is obviously very critical. And then those royalty assets that I talked about earlier. So what's really key about this strategy is that the underlying constituents of each of the three categories of infrastructure tend to move in different ways in different market environments. So we have a natural diversification across the three categories, across the various sectors and subsectors. Then, of course, this is a global strategy. So we are globally diversified. So let's take an example, a little case study, now that we're talking about digital infrastructure, where we actually do have some exposure here in South Africa. We own a company in the portfolio that we've had since day one called American Tower, which I keep saying is inappropriately named, because while they have 43,000 towers in America, they have nearly twice as many in India and in other various emerging markets where the rush and the importance of digital connectivity is obviously very clear. And for that reason, and because of that emerging market growth, as well as improving network density and the rollout of 5G and so on, they've been able to compound their dividend growth at a 16% annual rate over the last 6 or so years. So that's a very impressive outcome. And this is the kind of company that we invest in a listed infrastructure portfolio. So if we come back to those sustainable development goals, maybe a little bit on our process and how we think about it. I've already given most of this away. We analyze the revenue of every company on a line-by-line basis. We map those revenues on the underlying assets and activities to the sustainable development goals. We classify, we consider for portfolio inclusion, and then we maintain ongoing oversight of those holdings to make sure they continue to be doing what they're doing. And the outcome is, as I mentioned earlier, more than 80% of the revenue, the underlying revenue and assets under management of the portfolio contributing directly to sustainable development goals. So it's time to get optimistic, okay? Because I have a vision, after having spent 3 weeks here in this wonderful country, of how we can start to solve some of the issues with infrastructure. Surprise, surprise, how else are we going to do it? Now, I don't want to make in any way light of some of the difficulties that we all face. So this is partly tongue-in-cheek, trying to suggest some possibilities for outcomes, particularly around energy security. So you all know the issues, and please don't throw anything at me. Please don't throw anything at me, because I think the first step in solving the energy security issue in this country is actually centered around a fossil fuel. But it's not coal, it's gas. Can anyone tell me the fastest and most expansive decarbonizing nation in the world today? Clue, it's a big country with a large population. China, thank you. How is China decarbonizing more quickly than any other country in the world? It's not because they're building 32 nuclear power plants, which they are today, and it's partly that. And it's not just because they're rolling out a lot of renewables. It's because they are replacing coal-fired power, coal-fired chemical processes, and coal-fired heat in industrial and commercial applications with gas. They are buying all the liquefied natural gas they can get their hands on. The biggest buyer of liquefied natural gas in the world. It used to be Japan, it's now China. So building a regasification facility is actually pretty simple, okay? A liquefaction facility, on the other hand, is very complicated, because the way liquefied natural gas works, I'm sure most of you know, is you take raw gas from the field in Qatar, in Mozambique, in the Gulf coast of the United States, and you chill it to insanely cold temperatures. I don't even remember how cold they get, but almost as cold as a Canadian winter, apparently. You then liquefy it through that freezing, that cryogenic process, and you put it on these massive bubble tankers, and you ship it around the world. But a regas facility simply depressurizes that gas, brings it up to temperature very carefully, and pipes that gas in. And I've put some little power plants next to the regasification facilities that we can dot along the coast. Okay? Pretty straightforward. And what that does is it creates baseload. And it creates a lower carbon footprint form of power generation for the country than burning coal. Right, that's the first step. And then the thing we're going to do, and by the way, that's infrastructure. The next bit of infrastructure is a properly functioning long-haul transmission network. A grid that actually works and takes the electricity from the places where it's produced very efficiently to the places where it's needed. So this is a very important element. It's important alongside more efficient low voltage networks. So of course, high voltage transmission lines carry the electricity for large distances. The low voltage networks distribute it to all of the households and commercial applications. And they need to be solid. They need to be smart. They need to be bidirectional if we're producing our own power on our rooftops, right? What do you do with the excess energy? It's got to be sold back onto the grid, right? I saw lots of renewable energy up in the Eastern Cape, wind farms and so on. And you drive along and you see this array of wind farms, let's call it 10 turbines, and only 2 of them spinning. Why were the other ones just stopped? They weren't broken. They had the brakes on because there was nowhere for the electrons to go. You had excess power because you didn't have a grid that would take away that power and distribute it in the appropriate places. So then we got our low voltage networks, which means then we can start to build renewable energy assets all around the country, properly connected. As Sadila has pointed out at a very spirited debate at dinner the other night, it's like there is this massive resource, namely the sun. Thank you very much. I live in London, by the way. We're just learning what that is. We've got to make use of it. And of course, it's very windy in many parts of the country as well. And if you can connect that renewable energy appropriately on the network, you can do very well by it. And then, let's build some offshore wind too. Why don't we? We have a lot of coastline, got a lot of wind. There's a new technology in offshore wind, which is floating turbines. You don't have to fix them to the seabed because you've got a very difficult topology. Is that the right word? In the seabed, so we got lots of floating offshore wind. Connect that all up to the grid. Let's add a nuclear power station just for fun, just for a little bit more base load. I know we're really dreaming now. And then we can all enjoy a cocktail looking out at the beautiful sunset wherever we happen to be in South Africa. So that's the dream. But I think we're all very well aware that that's not going to happen anytime soon. But what's very interesting, and this is a little twist on the story, is that there is a country, points for the correct guess here, where I can put all of those infrastructure elements where they are actually in place or being developed at a very rapid rate and very successfully, including those LNG regas facilities up in the north. There's your first clue. Anyone know what country this is? It's not Holland. You're close. It's not Norway. That is the Atlantic North Sea. It's Germany, which, out of desperation, have had to really address their infrastructure issues because on a fateful day in 2022, the Russians invaded Ukraine and suddenly they didn't have any cheap, abundant gas. And they said, right, we've got to address this issue. And so they got to work. They had 2 LNG regasification plants built in 2 years. They were bringing gas in from other countries. They're reconfiguring the long-haul transmission network, extended the life of the nuclear, refurbishing their low-voltage networks, and building renewables as fast as they can. And as a global investor, we have had access to this opportunity through companies such as Ørsted in the offshore wind realm, Enel in the electricity transmission and distribution business, Elia in transmission, E.ON in distribution, and finally Sempra, which is a US company that liquefies natural gas. And so the real tragedy is that for a South African, addressing the issue in this country is not really possible through infrastructure investing, particularly in the listed realm, which highlights the importance of going global. And I don't see that as unpatriotic, because I think all of you really understand the challenges around infrastructure and how to solve them, but the investment opportunities tend to be international. So the investment opportunity today for us as a fund is that these kinds of businesses have been left behind from a valuation point of view. The utility sector last year had its worst underperformance period against the broader equity market in 30 years because, of course, everybody's chasing those sexy tech stocks. And the irony, once again, lots of ironies here today, is that these businesses are delivering better than they have in the histories of our holdings in the last year. So they are delivering. but they're not getting appreciated. And that for me is a great opportunity, a great disconnect. And as a listed infrastructure asset manager, I can rotate capital to take advantage of those opportunities very quickly by region and by sector and by subsector. The private investors are doing much the same. I mentioned earlier that BlackRock has made a significant move into infrastructure, again, in the private realm. They bought an outfit called Global Infrastructure Partners, which we knew very well. They were also buying some of our listed securities, by the way. And just to give you a sense of how big this deal was, the partners of Global Infrastructure Partners, individuals that started the business, as a result of this transaction, became the second largest shareholders of BlackRock. Can you imagine? It's a lot of wealth. And this transaction was done at a significant premium versus where you would typically see asset managers change hands. And so Larry Fink has made quite a few quotes about the opportunities in infrastructure. They're not alone. Brookfield's doing the same, a Canadian company. Macquarie's doing the same, Australian. I don't know what it is about Canadians and Australians' obsession with infrastructure. I really don't. I mean, as a Canadian, you're born with skates on and an obsession with infrastructure. That's apparently how it goes. And there are other players that are actively pursuing infrastructure opportunities in the private realm, as well as in the listed realm. Brookfield has actually been buying some listed securities as well and bringing them private, partly because then they can actually affect outcomes. So they actually have a fund called the Transition Fund, where they actually, quote, go where the emissions are. They buy the companies where emissions are high, and they change those companies through engagement, through direct ownership, to decarbonize them and achieve better outcomes. And this is an asset class typified here by the utility sector that compounds earnings, cash flows, and growth quite consistently over time. This is a 20-year investment horizon. Yes, there's a little bit of cyclicality in there, but what's wrong with an asset class or a sector that can compound high single-digit returns consistently over time? You actually, dirty little secret, you actually, over a 20-year period, can outperform the global equity market with a high-quality basket of utility businesses. It's amazing. It's boring. It's not as fun as chasing Tesla and NVIDIA and having all that fun, but it works. It works. It's like a long game of Monopoly, which somehow I always lose to my kids at. Maybe I should be proud. I don't know. So that's the chart here. The global equity market having returned 5% over the last 23, 24 years. The global utility sector, and this is all of them. This isn't even the best ones. I mean, we're active managers. We go and try to pick the best ones. It's actually outperformed the global equity market. You heard it here first. I'm going to conclude, again, on a positive note, thinking as a long-term investor, in keeping with this chart, with many of the driving structural themes that benefit the asset class and some of the various companies that we have listed here to take advantage of those opportunities. And we're talking about, of course, renewable energy and energy security. We've talked lots about that today. Haven't talked as much about transportation of the future, which is, of course, electrification of transport, whether it's passenger or rail or what have you. Increasing urbanization needs, particularly in emerging markets, requirements around transportation, infrastructure in particular, that universal connectivity that I talked about earlier, bringing digital access to the world, a more circular economy and the infrastructure that's required for that, whether it's around water or waste, and then healthcare infrastructure and demographic-oriented infrastructure to address the opportunity of an increasingly aging society. So we'll just give you a little bit of detail on the fund itself without being over promotional. This is a strategy that we launched 6.5 years ago. We started with zero capital. I was actually the first investor in the fund, technically, with 100% of my own pension plan. Now, I know you're much more diversified than that, but for me it works because I get to come in every day and manage my own retirement funds alongside everybody else's. We've grown the fund in the Luxembourg vehicle to $2 billion. Got another $1.5 billion in other mandates and other vehicles, so it's a $3.5 billion highly scalable strategy with, again, an objective to grow the income to our unit holders every year in base currency terms to protect against inflation and achieve a total return these days in the high single digits plus potential re-rating of the underlying assets. So it's a very exciting time to be looking at the asset class, to be looking at the strategy. And in US dollars, we've managed to deliver a mid-single-digit return in the asset class versus the peer group of less than 1%. So we're very, very proud of that. And importantly, this is also a strategy that protects capital in difficult market environments. So when we get big downdrafts in equity markets, which, if you read the tea leaves, might be coming soon, it's a strategy that preserves capital, such as 2018, where the market was down 9%, the fund was down 4%. Or importantly, 2022, the market was down more than 18%, and the fund preserved more than half that capital, being down 7%. But also in other years, demonstrating that we have upside participation because of that focus on growth in particular, and all the opportunity sets that I've been talking about.